Did you know the Fed plans to raise rates twice this year? I found 5 tickers that can make higher returns when they do. This video is not financial advice, nor is it a recommendation. Please do your own due diligence before investing into anything. Any company or fund that owns or originates floating rate debt investments makes more every time the rate floats higher with Fed rate hikes. This can mean higher dividends or just a higher share price. First on this list is a floating rate loan ETF. It pays a dividend yield of 4.39% according to Seeking Alpha. This fund holds mostly corporate bonds with some government bonds sprinkled in, along with some cash and cash equivalents. As you can see here, the share price went up sharply last year as the Fed raised interest rates. This is the iShares floating rate bond ETF, ticker symbol FLOT. Next up, we have a floating rate loan ETF that pays a dividend yield of 5.9% according to Seeking Alpha. This one only holds corporate bonds and cash equivalents, which explains why the dividend is slightly higher than the other floating rate bond ETF on this list. As you can see on this chart, this ETF also benefited from last year's Fed rate hikes and might likely benefit from future hikes this year. This is the BlackRock floating rate loan ETF, ticker symbol BRLN. Next on the list is our first business development company that pays a dividend of 10.89%. They invest in equities of private companies in addition to senior and junior secured debt, most of which tends to be floating rate interest debt. This company has provided relatively stable dividends over the years and even raised their dividend to over 10 cents a share earlier this year as a result of the added income from all their floating rate interest debt going up. This is PennantPark Floating Rate Capital, ticker symbol PFLT. This next business development company is a bit more diversified than PFLT. They invest in a range of different equities, but also originate different forms of debt, including bridge loans, which happen to be floating rate. In the face of possible interest rate hikes this year, this company has an opportunity to focus on doing more bridge loans to take advantage of the higher interest rates. Likewise, this could also mean better returns for investors if they capitalize on this opportunity. They pay a dividend yield of 11.33%. This is Oaktree Specialty Lending Corp, ticker symbol OCSL. Last but certainly not least on our list is an ETF that specializes in cash flow and pays a whopping 17.38% dividend yield according to Seeking Alpha. This fund buys and holds another ETF which owns long-term 20-year treasury bonds and writes covered calls against those shares to generate their monthly dividends. While the Fed rate hikes may actually hurt share prices in the short term, as the underlying ETF begins buying new treasuries at higher interest rates, its share price will gradually increase, meaning a Fed rate hike may present a buying opportunity as the share price drops short term. This is the iShares 20-plus year bond buy right strategy ETF, ticker symbol TLTW. If you like this video, you might also enjoy this one here on the screen. Subscribe to join the Cash Flow Club and hit the bell for notifications so you don't miss a single video.